Hi, this is Alex Mahoney with Coda Financial Coaching. And today I'm going to discuss what you should do if you feel nervousness and uncertainty about how the market is doing. Now, of course, since 2020, since the COVID crash, with the exception of 2022, the market has done very well. You would have done very well if you had participated since 2020. And for that matter, since 2008, except for the crash of 2020 and a correction in 2022, the market has done very well in the last 15, 16 years. You could say in the last generation. But that doesn't mean that you're wrong to feel uncertainty or a little bit of dread about everything that's going on in the world right now and what that could mean for your investment. So, really, before you start using the tools to manage this uncertainty and help you sleep at night, the best thing to do is determine your level of risk appetite. And I would break this down into three broad categories. I would break it down into aggressive, moderate, and low risk. And what you do is you determine which of those categories that you fall into. And the formula from there is pretty simple, especially if you're a casual investor. And that is if you're an aggressive investor, and I am aggressive, and I would say aggressive doesn't necessarily mean you are taking undue risk or risk that is very heavy. It just means that you lean more towards stocks and you don't mind, even in a turbulent market, investing in stocks, even knowing there could be a correction ahead. So I would classify myself as an aggressive investor. And a more moderate to a lower risk investor is going to be in more in bonds. So once again, the aggressive investor is not necessarily means they're getting in all sorts of crazy investments or new crypto or stocks that nobody has heard of, but their buddy at the bar told them that they're going to the moon. It just means that you are more heavily invested in stocks. So what you do is if you're aggressive, the number 120 is very important. And why is that number important? Because that is the number from which you subtract your age, and that determines your overall stock allocation. If you're moderate, that number is 110. So you take 110 and you subtract your age. And of course, the classic kind of Boglehead advice, that's Bogle was the big investment guru that really taught people how to save for retirement, is 100 minus your age, which I would argue is very conservative considering the stock market has done very well in the past few generations, and that you would have missed out on big returns if you had stuck in a more bond heavy, especially government treasury bond heavy portfolio. So, okay, so how do we from there, how do we actually manage that, right? Because we're okay, say you are a moderate investor and you're subtracting your age from 110, right? And you're constantly having to rebalance because the stock market is going up and down in order to maintain, let's say you're 30 years old, so that means you're 80% in stocks if you're a moderate investor. So how do we maintain that and not lose our sanity always buying or selling bonds and stocks in order to accommodate the ups and downs of the market? Well, of course, one option is to do what's called rebalancing yourself. And all that means is that, let's say you have, you're a moderate investor, thus you have 80% stocks, and you're 30 years old. So you have 80% stocks, you have 20% bonds. That means when the stock market goes down, now bonds are suddenly a higher percentage of your portfolio than stocks were, of course, right? Because now those stocks are lesser value, the bonds have remained relatively the same. So maybe the stocks are 70%. So that means you actually have to sell some of your bonds and buy stocks. So you do have the option to do that. I would argue that unless you're a complete investing nerd, that is a very burdensome approach and can cause you to incur fees in certain cases, and also trigger tax consequences in certain cases. So that may not be the best option for you to rebalance yourself. So what I would do is, if you are especially risk averse, and you want to make sure that you have a consistent allocation between your stocks and your bonds, is to invest in a target fund. So, first of all, let me explain what target funds are. So, what you do in target funds is you pick the date that you're going to retire, the year that you're going to retire. And let's say for me, that's going to be around, I would say 2050, or I can't talk, 2055. And then you invest in the fund with that same name. So I would invest, if I wanted to be in a target fund, I would invest in the 2055 fund, right? So what that does is, when you first start, when you're a young buck in your career, that target fund, that 2055 fund, let's say you start working in 2010, is going to be very heavily geared towards stocks, right? And it's going to be very lightly geared towards bonds, government treasuries, other safer investments. And then as you move forward in your career, that allocation starts changing. It starts leaning towards bonds and away from stocks, especially from riskier stocks, high growth stocks, and it starts really leaning into bonds. So if you are extremely risk averse and nervous about this market, what I would argue you should do, even though I think you should stay in either your target fund, or especially if you have over 10 years to retire, you should really be heavily leaning towards stocks because you have plenty of time to recover. But if that risk profile is not for you, if you truly are nervous that we are headed to a correction that may take years to resolve, an option for you is to get in a target fund that may be a sooner year than your retirement. So my advice would be, if let's say your target fund would be 2065. Now, if you are a little bit nervous, what you could do is you could lop 10 years off of that target fund and actually invest in the 2055 target fund. So that leans you more towards bonds than you otherwise would be if you went with your retirement year. And what that does is, if the market continues to go down, you're actually getting an advantage there, because your fund is selling off the significant number of bonds in that fund, and it's buying stocks at a discount, right? Because the stock market is going down. So you're actually getting a bargain on stocks, and you're doing it in a portfolio that has a lot more bonds to sell than you otherwise would if you were in your normal target fund. Now, if you're very conservative, what I would suggest you could do is you could even pick a target fund 5 to 10 years in the future. And if you're very young, obviously that's very conservative, but that really allows you to be in a lot of bonds and weather a storm without much impact to your portfolio. And it just gives you peace of mind, right? And you don't have to, in the meantime, really manage the constant rebalancing of your portfolio, because you already have that target fund working for you. And if it's let's say you pick a 2035 fund, so you go only 10 years in advance, even though your normal target date fund would be 2060. My guess would be, in most target funds, you're probably talking about, at that point, a 40 to 50% allocation in bonds. That is a lot of cushion for somebody who is nervous with the stock market, and really allows you to weather the storm there. So that's all the advice I wanted to give. I still recommend that you stay in the stock market as much as you can, especially if you have over 10 years. you're just you're going against history if you are not in the stock market and you have over 10 years of your working life to let any bad stock market recover. You're just going against history and you're losing out. You're not giving the stock market an opportunity to recover like we always see happens. But that doesn't mean that if you know that you're a bad or you're wrong person for wanting to be more conservative. So if that target fund for you that's only 10 years in advance is for you, that's a way to stay in the game. You're not totally out of the stock market game, yet be safe in a very volatile stock market. Anyways, feel free to drop some comments, any questions that you may have around your portfolio allocation, around rebalancing, around target funds versus index funds. I'm happy to answer any of them. And I hope you have a very happy investing journey in the next several years, and we will talk soon.